During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results, we'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarise our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. The higher the number, the more profitable the company. Earnings per share growth is down by 3%. Now let's look at the free cash flow, which is the money a business can generate from its operations. Free cash flow growth is down by 34%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Revenue growth is down by -2%. Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company. And book value growth is up by 4%. Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control. Return on invested capital and return on equity are very healthy at 16% and 18%. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. And debt can be paid off in just over 2.5 years. In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. Gross margin is 66%. Next we come to the operating profit margin. This tells us how much profit a company makes on $1 of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. And the operating profit margins is great at 25%. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability. He typically looks for a company that has a free cash flow yield of 5% or higher. And they have a superb free cash flow yield of 6.72%. As we are potential shareholders, we will now want to look at the average book value growth for the last 10 years, and this is only 3%. Ben Miller believes earnings growth is the biggest indicator to a company's stock price, and this barely moves the needle at just 1%. I've included a link if you want to check out the investors page and see the annual report. This is Bitesize Investments, giving you a step-by-step approach to your investment journey. There are currently 7 super investors who own this company. If we look back at Joel Greenblatt's previous sales and purchases, we can see he has both bought and sold shares in Cisco over the past few years, and has increased his stake in Q1 of 2024. He has 19.5 million invested in Cisco, and this makes up 0.31% of his overall portfolio. However, 9 other super investors have sold shares. Jeremy Grantham has previously bought Cisco shares, but over the last year he has been selling. He has 57.5 million invested in Cisco, and this makes up 0.21% of his overall portfolio. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. We can see that from 2014 they have been in an upward trend until the pandemic dip. They regained their position but have traded sideways since then. On average, the analysts believe the price target should be about $56, but some believe it can go as high as $76. Analyst reports suggest that Cisco is undervalued at the moment, and the overall consensus is that Cisco is a buy, but only just. Collectively, the analysts believe the company will possibly grow up to 23%, but they also think it could shrink by -4% over the next few years. Today we are going to use a dividend discount model, as I personally don't see Cisco growing like they have done historically. So to work out the dividend expected growth rate, we need to plug in the dividend payout ratio, which is 53%, and enter the return on equity, which is 26%. We use both of these two numbers to calculate the expected growth rate, which is 12%. We then plug in the dividend per share of $1.57 and use the expected growth rate to calculate the expected dividend, which is $1.76. After that, we add our risk-free rate of 15%, the current beta of 0.85, and the market risk premium, which is 4.35%. This gives us a total cost of equity of 18.70%. And finally, we can use the expected growth rate, expected dividend, and cost of equity to calculate our present stock value, which is about $27. If you found this video useful, click on the link to check out my last stock analysis. Using my dividend discount model, my calculated fair value is $27, whilst the current stock price is about $46. Therefore, there's a 69% difference between both values. If you were to reinvest a current dividend of $1.57 and it were to stay the same, it would take about 4 years and 4 months to get to today's current stock price. The dividend growth for Cisco is 1.95 and the payout ratio is at its highest acceptable level of 53%. So it's questionable if the company is capable of becoming a reliable dividend income. According to Morningstar, they believe that Cisco has a wide economic moat, and this is because there's renewed confidence in the ability to maintain its leadership and continue to generate durable returns in the evolving networking market. The bull case for Cisco is that they have a strong financial performance, a healthy balance sheet, a reliable cash flow, and a competent management team. In addition, they are a market leader in the networking and communication space, and lastly, they are a company that continues to invest in new technologies which could maintain their longevity. The bear case for Cisco is that they are now at a saturation point for its core networking business, which will affect their ability to grow. In addition, they operate in a highly competitive space with other companies attacking their moat. The current global uncertainty could also affect consumer spending on IT infrastructure. If you've enjoyed the video, it would be greatly appreciated if you would like and subscribe to help the channel grow. And finally now we'll summarise what we found out about the company. When reviewing the key pillars, Cisco scored 6 out of 12. Under ownership, 7 super investors have bought in the last few quarters and 9 have sold shares. Cisco's average share price is trending sideways, and analysts are indicating that Cisco is a buy, and they are predicting they will grow as high as 23%, but could also decline by -4% in the future. Using the dividend discount model, my current buy price would be $27 or less, and if you'd like to click on the link above, you can find out about my personal portfolio. According to Morningstar, they have a wide moat, even though they exist in a highly competitive space, and my final overall rating is 2.5 stars out of 6, and I have given this a category C rating within my own stock watch list. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comment section to help me develop the content I am creating. And don't forget to like and subscribe.